Look at all the people who bought silver during the silver squeeze that got pissed off because it didn't do what they thought it would. And that's cartel work in action, where they held it down when it really, if price discovery would have been allowed to happen without 8 banks holding the largest concentrated short position in the history of the COMEX, well, then the price would be much higher. But you can see that's now broken because the LBMA has the lowest silver float, 155 million ounces that they've ever had, ever. That's 1 day worth of trading. And we're supposed to believe that it's a shortage of trucks and manpower why people can't get their bars for 8 weeks. As you can see, they've been caught with their pants down, and they're this close to the whole thing breaking.
The silver market is approaching a critical inflection point, and this time, the stress is not hidden behind obscure data. It's unfolding in plain sight. At the heart of the crisis lies the London Bullion Market Association, LBMA, and the COMEX, the 2 institutions responsible for global silver price discovery. Their credibility is now under siege. According to Andy Schectman, CEO of Miles Franklin and a longtime critic of the paper silver regime, we are witnessing the breakdown of a decades-long system designed to suppress the true price of physical silver. For the first time in recorded history, the LBMA's freely available silver, known as the float, has collapsed to just 155 million ounces. That's less than a single day's worth of spot trading volume in London. At the same time, COMEX commercial banks are holding the largest concentrated short position ever, over 400 million ounces, and are now deeply underwater as silver prices surge above $39. These are not minor fluctuations. These are signs of a market under extreme duress. Behind the scenes, evidence of structural failure is mounting. The lease rate to borrow silver, a proxy for stress in the physical market, has exploded as high as 8%, while platinum lease rates have spiked to 18%. The LBMA has quietly extended settlement timelines from 1 day to 8 weeks, blaming logistical constraints. But the real issue is far more alarming. The metal simply isn't there. This is a full-blown liquidity squeeze in the world's most important silver trading hubs. Andy's analysis points to one unavoidable conclusion. The paper silver market is unraveling. The ability of a handful of bullion banks to artificially suppress silver prices through unbacked futures contracts is rapidly disintegrating in the face of vanishing inventories and relentless physical demand. When the short squeeze accelerates and faith in the paper system collapses, silver will not just rise, it will reprice to levels that reflect its true scarcity and strategic value. This is the setup of a generational opportunity. If you've been waiting for proof that the silver market's long-standing price suppression is finally collapsing under its own weight, this is it. In the next segment, Andy Schectman dives into the hard data, from historic short positions to soaring lease rates, and lays out exactly why the paper silver market is on the brink of a major reset. Before we dive in, if you find value in content that cuts through the noise with real analysis on precious metals, please give this video a thumbs up. Don't forget to subscribe to the channel and hit the notification bell so you never miss a critical update in this rapidly evolving market. Thanks, and enjoy the video.
Yeah, well, I mean, it seems to me that the silver market and maybe the platinum market are under stress. And if you look at that chart that Ed Steer provided you way back when that we've talked about the short positions, silver and platinum are the number 1 and 2 most shorted commodities on the COMEX market. And it seems like, and again, I don't want to get too excited because we've been through this so many times, the little boy who cried wolf, we always know that the wolf does come, but it seems like the paper futures market prices are kind of disconnecting from the physical prices after all of these years. And what you're seeing really are traders rushing to secure physical metal, possibly to avoid, risk if physical shortages worsen. First of all, obviously, this is a very bullish environment for metals and could trigger more volatility. But in general, what we're seeing in silver is different than anything I've ever seen in this marketplace. So you have a guy named Daniel Gali of TD Securities, where he argues that the outflow of silver caused by the tariff arbitrage, and I don't think it's just a tariff arbitrage, that's what they want us to believe, has left inventories of freely available silver critically low. In fact, the LBMA, the London Bullion Metals Association, silver free float now stands at the lowest level in recorded history. So this is the most influential silver market on the planet, the LBMA, and it's at its lowest level of silver holdings ever. We've talked about this, Dunnigan, ad nauseum, the drawdown in silver off of the exchanges. And he writes, the so-called free float of inventory at the LBMA has dropped to just 155 million ounces. That's less than a single day's worth of trading volume for spot silver in London, and it makes an unprecedented squeeze in the world's most important silver trading hub. The result is a dramatic spike in the cost of borrowing silver, with 1 month lease rates soaring as high as 8%, and a level almost never seen in this market. If you have to pay 8% to lease the silver in order to cover a position, you're in big trouble. And, you know, David Jensen, who does a masterful job of talking about what goes on in the LBMA, says that they're actually trading about 1.9 billion, with a B, ounces per day, 3.5 times annual global mine supply, and in this case, well over 10 times the float every single day. Now, he says that they trade roughly about 190, 200 million ounces or somewhere in that neighborhood, but those numbers are 10 times understated, as they only post the final settlement number. So when you're trading, in essence, pretty dang close to 2 billion ounces a day, and you only have 155 million ounces backing it, what could possibly go wrong? And that's the situation where LBMA has gone from T+1 to T+8 weeks, citing a shortage of manpower and trucks. Couple other things we're talking about. The last week's COT report, or this week's COT, Commitment of Traders report, just came out on Tuesday. And it's interesting. It shows that the commercial banks have 79,600 contracts net short. That's about 404 million ounces. The interesting thing is that they built this short position at or around $37.50 when they dumped a whole bunch of silver short. But now silver's over $39. These traders are freaking out, and they're bleeding hard. That shows let's see here, a silver about $2.50 higher. That would be a paper price loss of pretty dang well near $1 billion in 3 days. So not only has the silver price hit its highest mark since 2011, the banks have just set a new record for the largest short position ever in the history of the COMEX market, ever. And they're underwater $1 billion in 3 days. Now, the silver EFP, which is the exchange for physical, surged by 250% in the last couple of days. What does that mean? That means that it's the cost to swap physical silver for futures has skyrocketed by 250%. This increase would signal massive stress in the silver market. It means that traders are scrambling to find any silver they can, which is in short supply on that level. And this is a major move that would typically only reflect massive tightness in the physical market or a lack of trust. And that's a scary thing. So you have skyrocketing lease rates. Lease rates are between 6 and 8%, very high. And by the way, platinum lease rates just popped up to 18%. That's extremely high. It says extreme tightness and extreme demand for physical to metal. You also have the gold EFP rates that just jumped up $4.50 just yesterday. That's another sign of dislocation and demand for physical delivery. So when you got gold and silver and platinum lease rates blowing up, you have the exchange for physical rate blowing up, you have the T+1 going to T+8 blowing, or 8 weeks blowing up, and on and on and on. This is a sign that we hadn't begun to see where this market ultimately goes. And you have these big traders that are heavily short and expecting prices to fall, but the market goes the other way. It's a scary thing. And at the same time, you have all these premiums jumping. This has to have the banks rattled. Couple other things that I noticed over the weekend. David Bateman. Are you familiar with who that is, Dunnigan?
I haven't followed him.
He's a billionaire. And I want to read something to you because I think it underscores some big money, right? So we've talked about that since the beginning of the year, the insiders, the institutions, the institutional traders have been selling equities every single week. Since June, they've been averaging about $2 billion a week selling. At the same time, ma and pa retail investors have the largest allocation ever to equities. It's even greater than the dot-com bubble. So what could possibly go wrong there? Since the beginning of the year, 6 sales, 1 buy by the insiders who know the trajectory of their business. None of that's good. At the same time, you have on the COMEX level and the LBMA level, which reeks of sophistication and inside info and money, they're ripping metal off the exchange at a level that's never been seen before, the lowest level of silver ever in the history of the LBMA, and the largest deliveries ever off the COMEX. Not a good thing. That's done by institutional traders. On our level, me and you, we see most of the retail public has no idea what a gold or silver coin is. So you look at the dichotomy. The insiders are selling equities and buying commodities and standing for delivery, while the retail public has nothing in the way of commodities and is all-time record in equities. What could possibly go wrong?
As Andy Schectman points out, the exodus from paper assets isn't speculative. It's already well underway. One of the clearest, most public signals of this shift comes from billionaire investor David Bateman, who recently disclosed a staggering billion-dollar bet on precious metals, including the purchase of 12.69 million ounces of silver, roughly 1.5% of the world's annual supply. In a statement that's gone viral among financial circles, Bateman laid out the rationale behind his move. Here are the reasons I invested close to $1 billion in precious metals over the past 6 months, including the purchase of 1.5% of the annual global silver supply, 12.69 million ounces. The global monetary system is about to collapse, the Great Reset, or Basel Endgame. The biggest credit bubble in history will soon pop, $300 trillion. There is no way the U.S. can refinance its $28 trillion in maturing treasuries in the next 4 years without an obscene amount of printing. Gold and silver are the only meaningful life raft. Physical possession is everything. Crypto is a psyop. Those who purchase will have no chair when the music stops. Real estate, crypto, stocks, and bonds will all lose significantly compared to precious metals. The banking system has been meticulously designed to seize your assets to buoy up a collapsing banking sector. See the Great Taking. You have zero counterparty risk with precious metals. I'm up 20% already on most of my purchases. This is not a drill. Your grandkids someday will either muse or lament this financial decision you're now faced with. Don't fail them. Let's get back to Schectman's analysis as he exposes how industry insiders like First Majestic's Keith Neumeyer are helping to speed up the collapse of the paper market.
That's called disintermediation. And in other words, you disintermediate the players in the market by going directly to the end user. And that's great. A lot of companies don't have the wherewithal to do that financially. Keith does. And I spoke with him about that too, and I really respect that. And on a larger scale, isn't that what China is doing when they go directly to the miners in Latin America and buy doré and concentrate, send it home and refine it for the end users, rather than letting it go through the channels and pulling it off of the exchanges, which then is very transparent. By disintermediating the market, you are taking out of the equation. You see, the way that this normally works, and the reason that the bullion banks have so much sway, is that mining is very expensive, and for many years the mining companies have really suffered with lack of a market that was cooperating, prices that were muted, and really not much interest by the public, and so they suffered. Well, when they pull stuff out of the ground, it's very labor and cost intensive. They will call a bullion bank like JP Morgan and say, we got X amount of tons of doré. What do? They'll say, ship it to this refiner, we'll have a wire in your account in 30 minutes. So they get paid like that, they ship it off, now it's in the hands of the cartel, so to speak, who can refine it and then put it onto the marketplace on COMEX or whatever and do what they want with it. So what Keith is basically doing is saying, screw it, I'll just refine it myself and sell it directly to the public. I'm not going through a bullion bank. I will disintermediate the process, go right from the ground to the end user. Well, that's what China's doing. And I think it's very shrewd. And but it underscores what China is doing, in my opinion, when you look at it the way Keith is doing it, and it gets out of the equation not only the ability of the cartel banks to hold it, possess it, short it, manipulate it, but in the case of China, it keeps all of the information out and it disintermediates the pricing of it because the metal is coming off of places that don't affect the price. So in either respect, whether it be Keith doing this directly to the public is good for all of us, and ultimately good for Keith. But when China's doing it, I think it's good for them, and it allows them to continue to accumulate stuff without the prying eyes of the IMF and without it being reflected in price on COMEX or the LBMA. And quite frankly, I don't think they care about price. This isn't about price as much as it is disintermediating the information. People are attracted by price. Most people don't have the patience or the ability to sit and learn from guys like you and I and get out in front of it before the price moves. So when the price goes, silver is what's called inelastic, meaning it's used in industry and it's needed in industry. It can't be substituted, but it's used in such small amounts it doesn't materially affect the price. If you have a fifth of an ounce of silver in an iPhone and silver triples, it's really not going to matter that much to the ultimate price of the iPhone. You still need it. But if more and more people notice a higher price, they all start buying it. And that is what the big players do not want, where they get shut out of the global supply because everyone runs to it. The cartel has done a great job at suppressing price, but by suppressing price in a way that with great volatility and counterintuitive to the times, it disenfranchises people. You look at all the people who bought silver during the silver squeeze that got pissed off because it didn't do what they thought it would. And that's cartel work in action, where they held it down when it really, if price discovery would have been allowed to happen without 8 banks holding the largest concentrated short position in the history of the COMEX, well, then the price would be much higher. But you can see that's now broken because the LBMA has the lowest silver float, 155 million ounces that they've ever had, ever. That's 1 day worth of trading. And we're supposed to believe that it's a shortage of trucks and manpower why people can't get their bars for 8 weeks. As you can see, they've been caught with their pants down and they're this close to the whole thing breaking. The masterful part of what China has done through all of this and all the BRICS nations is not gobble it too quickly because it would have broken the system like that. Instead, they've been doing the little by little by little and pickpocketing it every way they can since you and I started talking about this 5 years ago, and it's coming to an end. And again, I do believe it is, which will ultimately signal perhaps, I don't want to get out in front of my skis, but perhaps this is the beginning of the end of the manipulation of the metals market. You could argue it's almost already here with gold, but look at silver. They hit it again today and it's back up. It's barely back up, but they can't keep it down. We got futures at $39 and I don't know, if you look at the so-called resistance between here and 50, there's some at 41 and some at 42.50 are right in that range. But that so-called resistance cumulatively, if you look at the 1980 peak and the 2011 peak, they were both quick peaks, right? Those two levels were maybe 1 to 2 days of trading, period, over the last
45 years.
50 years, 40 years. That's not resistance in my mind. That's just a stopping point on the way. It would signal to me there would be resistance that would be easily taken out. And once you get above 50, the sky's the limit. Now, if we just were to take the price of gold today and divide it by 45, which has pretty much been the average price of the last 150 years, if we woke up tomorrow and saw silver at, divided by 45, $79, that would be where it should be on a 150-year average basis. But as Keith will tell you, it's coming out of the ground at 6 to 1, not 45 to 1. So you can argue that price is 11 or 12 times under what it should be based upon its geologic footprint in relationship with gold. I mean, all of this is theoretical, but any way you look at it, silver's time is coming. It's here. It's disappearing. The big banks are very, I think, concerned about this development where they're now being challenged by very sophisticated, wealthy players. It just seems like this might be the time that we've all been waiting for here heading into the second half of the year. See where silver ultimately ends up.
As Andy Schectman makes clear, we're no longer in the early innings of silver's awakening. We're nearing the tipping point. The stress signals at the LBMA and COMEX aren't just academic data points. They're proof that the current pricing regime is cracking. As this happens, more capital and more conviction is flowing into silver from serious players who are preparing for a reset. Billionaire investor David Bateman is one of them, and his public commentary has pulled back the curtain on how elite capital is now viewing silver, not as a speculative play, but as a strategic reserve asset. Back in April, Bateman warned, "There's approximately $300 billion spent each year buying newly mined gold for investment purposes. Silver is only a $25 billion annual industry. If just $5 billion, 1.5%, of gold's investment capital flowed into silver, the silver price would go stratospheric. That's just 10 investors like me around the whole world. A single country investing in silver could cause a generational silver breakout." He continued, "Think how many large investors silver will soon attract as banking sector stress returns. This is why there is a globally coordinated effort to suppress the price and demand of silver. There is less above-ground silver than gold, and silver is essential for manufacturing. It's in a 5-year structural demand-supply deficit. Silver's day is coming very soon." That wasn't empty talk. On July 2nd, Bateman followed through with action. "Just bought another 800,000 ounces of silver, 7,000 ounces of platinum, and 4,300 ounces of palladium today. I'm all in. A big move seems imminent. Game on." This isn't the behavior of someone speculating on a short-term bounce. It's a strategic position ahead of a global repricing event. And he's not alone. All signs point to a shift in institutional psychology. The paper game is unraveling, and the scramble for physical metal is accelerating. When the curtain finally drops on COMEX shorts and LBMA shadow inventory, the silver market won't just rise, it will detonate. So the question isn't whether silver will move, it's who will be positioned before it does. If you've stayed with us this far, now's the time to act. Give this video a like if you found it informative. Be sure to subscribe for more data-driven insights on precious metals and global finance. And don't forget to hit the notification bell, because as this unfolds, you'll want to be the first to know. The paper game is ending, and physical silver is where the real story begins.